Welcome to the Chrisman Commentary, Daily Mortgage News Podcast. I'm your host, Robbie Chrisman. Topics on today's episode include the seesaw in the bond markets over oil prices, my interview with Polunsky Beitel Green's Marty Green on why Fannie Mae and Freddie Mac's exit from conservatorship must be carefully structured to preserve market stability and protect borrowers, lenders, and the broader economy, and what sort of demand we're seeing at Treasury auctions lately. Thanks to today's podcast sponsor, Optimal Blue. Optimal Blue bridges the primary and secondary mortgage markets to deliver the industry's only end-to-end capital markets platform, helping lenders maximize profitability and operate efficiently so they can help American borrowers achieve the dream of homeownership. Out of Montana and Texas came news yesterday that Glacier Bancorp and Guarantee Bank Shares signed a definitive agreement where Glacier will acquire Guarantee in an all-stock transaction. The acquisition marks Glacier's 27th bank acquisition since 2000 and its 13th announced transaction in the past 10 years. As of March 31st, 2025, Guarantee had total assets of $3.2 billion, total gross loans of $2.1 billion, and total deposits of $2.7 billion. For more information on the details of the merger, as well as latest personnel news, products, software, and services for brokers and lenders, and more, visit ChrismanCommentary.com. Bond markets held firm yesterday as oil prices dropped sharply amid escalating tensions from uncertainty surrounding the ceasefire declared by President Trump between Israel and Iran, giving back and then taking away some of the safe haven premium for investors. Despite mutual accusations of violating the truce, oil prices have returned to pre-conflict levels, easing fears of an energy and thus inflation shock and helping sustain investor confidence, though the situation remains fluid. The extent to which treasuries could cheapen, likely causing mortgage rates to rise as a function of higher energy prices, is contingent on the ultimate impact on oil from the situation. Investor support for the inflation-friendly drop in oil prices was aided by an even-keeled Fed Chair Powell, who told the House Financial Services Committee that many paths are possible, one of which is that inflation could be cooler than expected, which would suggest the Fed could cut sooner. President Trump has intensified his public campaign against Fed Chair Powell, urging Congress to pressure Powell while he is providing testimony on Capitol Hill this week into cutting interest rates by 2 to 3 percentage points and accusing him of harming the economy by keeping rates too high. While Powell remains committed to a cautious, data-dependent approach and reiterated that more time is needed to assess inflation and economic conditions, speculation is growing that the Trump administration could name a shadow Fed chair ahead of the 2026 transition, an unusual move that risks undermining central bank independence and could prompt volatility in longer-term interest rates. This comes as multiple Fed members in recent days have broken from the Federal Open Market Committee's consensus to say that the Fed should begin cutting rates as soon as the next Fed meeting in July, should we receive a benign PCE inflation reading later this week. For today's interview, I wanted to welcome back to the show Polunsky Beitel Green's Marty Green to discuss why Fannie Mae and Freddie Mac's exit from conservatorship must be carefully structured to preserve market stability and protect borrowers, lenders, and the broader economy. He's principal of Polunsky Beitel Green and brings more than 30 years of high-level experience in legal banking and financial services industries to his client engagements. He advises clients on the latest rules and regulations covering residential lending, in addition to building on the firm's long tradition of delivering loan closing documents with speed and accuracy. President Trump has been in office now for more than 5 months, and there was all this talk of Fannie and Freddie exiting conservatorship. You and I have discussed the matter at length previously, but I would postulate that we're not necessarily any closer, aside from maybe a couple Truth Social tweets, but we're not any closer today to an exit from conservatorship or orderly exit than we were back in January. I'm hoping you can kind of tell me I'm wrong here, because if it's what they're ultimately going to do, you would like to have some steps toward that end goal taken. Where do we stand now versus where we were at Trump's inauguration when it comes to Fannie and Freddie? Has anything changed?
I would say the one thing that's changed is that people are talking about it more in terms of the administration. I think that what you have is some of the pieces in place toward that happening, such as the appointment of Bill Pulte to his new role and him leading the charge with respect to that. So I think that that was the first step, is you needed the person who's going to guide it out of it, if that's the case, and indeed the path. So I think that's happened. I think you're seeing greater discussions, as you mentioned, with the tweets and those kinds of things from President Trump. But then also, I think in terms of some speeches and other things that Bill Pulte has done, you're seeing some more discussion of it. But I think in terms of concrete sort of steps toward a privatization, I think you're right. I don't think a whole lot has happened, but I think that at least speaking about it and introducing the concept of it happening more quickly sort of certainly spurs the conversation, and at least has us start talking about some of those steps, first steps, what they might look like, so that they can commence at some point in the not too distant future. But I still think it's a little bit of ways for sure before we really see concrete things happening.
Could you walk listeners through what actually has to happen? Step one, step two, step three. Maybe that might be a little too granular, but in terms of you can't just snap your fingers and say, okay, now you're reprivatized. What are the actual mechanisms that need to fall into place or steps that need to be taken to reprivatize Fannie and Freddie? What does it actually take to get them from where they are to being a private entity again?
It really depends upon the approach that the administration wants to do, and sort of my guess is they're going to want to do this without the need for legislation, which actually speeds things up. It doesn't slow things down, but it does certainly mean that you're going to need to get a lot of different constituencies to agree on certain things. As to, for instance, what's the corporate structure going to look like? I think one of the big things that we have to figure out is what scale are they going to be coming into the privatization versus where they are today. Is there going to be some slimming of what they do? So there's a lot of policy decisions that I think first have to happen, because for the administration to really formulate what they want to do, they've got to really make those decisions, and hopefully engage people in the industry to kind of come to terms with what a consensus might look like with respect to that. But I mean, really, it's spinning off a public company is what you're talking about. But I do not think that the privatization is going to be that different than what the privatization was with Fannie and Freddie before, where they were government-sponsored enterprise but were privately owned in terms of shares of stock. But I do think that there will be some sort of guardrails put into place so that we don't have a repeat of what happened in 2008. One of the things that I think you're going to see a lot of discussion about, and you've already seen it from the president, in terms of what the implicit guarantee might look like. It's interesting when you talk to like Mark Calabria in the administration, he kind of makes a very, very good point that no matter what you do with Fannie and Freddie, they're going to be of such a scale and so important to the economy that they're kind of too big to fail. And so there's kind of, when you have an entity that's that size and that important to your economy, there's always an implicit guarantee. And certainly we've seen that with them being conservatorship the first time around. So there's a lot of policy decisions that have to be made. There's a lot of corporate issues that have to be made. There is some studies and other things that they've kind of promised the Treasury Department and others that they would do prior to any privatization. So there's a lot of steps along the way that you have to get there. But once you sort of get those things in order, it isn't like you need legislation to do it. You can do this as long as there's not going to be an explicit guarantee, I think, without Congress acting. So that could make things happen more quickly. But again, it's such a complicated matter with lots and lots of different constituencies, a lot of different policy decisions that have to be considered. So it's going to take a while.
I was going to say, help my dodo brain out here a little bit. You mentioned it's kind of like an IPO, and in an IPO, you get somebody to help take you to market. Who's actually taking Fannie and Freddie to market? Who's coordinating the efforts here? And that's kind of what I meant by the previous question. What actually needs to be done in terms of, we take this step and then we take this step and then we take this step and suddenly they're back to being out of government control?
Well, the first question I think that they have to decide is what is the capitalization for the company going to look like? Right now, they've been allowing Fannie and Freddie to retain earnings to kind of build up their capital base, which they've done a fair amount. But I think by most calculations, they're only probably halfway there. So if they were going to spin this out to the public, it would be the largest public offering ever because you need to raise that much additional capital in order for them to be properly capitalized for the current mission that we kind of anticipate they would end up having. So it isn't that different than just sort of the public offering, but how you do it because of the size and scale of it is sort of unprecedented. But the government's going to be involved in it, and then one of the other big issues that I think has to be certainly considered is how is the government going to be compensated for the preferred return that they have today, and then how are current shareholders of Fannie and Freddie that have been sitting on the sidelines for the last 17 or 18 years, how are those shareholders going to be treated in terms of this new entity as it sort of comes out? Again, a lot of policy decisions there that sort of got off of what your initial question was, which is really process. But I think that process really is not very well defined right now until we really have a plan for what they're going to look like.
So when we talk an orderly transition, that's obviously the best case scenario. What would a disorderly transition look like? And there certainly is the potential for that.
Well, I suppose there is. Although I think it would be, for them to not engage with industry players and others that need to have a voice at the table, deciding on a strategy that is not thoroughly vetted and thoroughly thought out, and then going forward with it, notwithstanding people opposing it, so that you end up with a marketplace that doesn't believe that Fannie and Freddie are going to be are going to serve the same purpose that they have historically, and so there's dollars in the market or something else like that happens where people, in terms of the trading of those securities, we don't have the backstop in terms of the liquidity that we had hoped. And so it becomes disruptive to the marketplace, at least in the short run, until things settle out. So I think the key thing for an orderly transition is early communication as to what the plan is, probably adjusting that communication based upon legitimate concerns that industry players and others in the marketplace have, and then adjusting that and then giving the market plenty of time of notice to adjust to whatever that new form of Fannie and Freddie is going to look. We don't see a market disruption in terms of mortgage-backed securities in the short term.
Yeah, no disruption would certainly be great, but I don't have full faith in that. And I say that because Bill Pulte spoke at MBA Secondary in New York, and he said, this is a 2026 issue. And then Trump tweeted 2 days later, or Truth Social 2 days later, no, this is an issue right now. And so there's been different communications about when the administration is going to address this. Do you have any thoughts on timeline here? And I'm sorry to make you speculate, but when it comes to next steps that we'll see and that sort of thing, what are you thinking?
Well, I think what you'll end up with that is that if we're trying to do something sooner, you're going to see probably floating different ideas that sort of come out rather than a concrete plan. I still think that a concrete plan is something that you're probably not going to see until 2026. I think there's too many other things that are going on. But I do think that you can sort of introduce concepts, introduce ideas, and build a framework off of that. And I think that's what you probably start sooner as opposed to later. But I still think that it's a 2026 as the earliest possible time that you're going to see a concrete proposal here.
I would ask you in follow up to that, doesn't then it become an issue of, hey, well, the midterms are right around the corner, and so Democrats will find ways to kind of kick the can down the road, thinking, hey, maybe we'll regain control of either the House or the Senate, and then this won't end up happening? Or, I mean, maybe Democrats are on board with privatization. I don't know. I mean, so I guess that's a two-part question. If it reaches 2026, will it become that much more difficult? And then how bipartisan of an issue is privatizing Fannie and Freddie?
I don't know that it's that. I mean, the way that you end up privatizing is going to be different between the Democrats and the Republicans. I do think that some of the fair housing components of Fannie and Freddie would be more important to the Democrats than they would to the Republicans, certainly to the extent that there's a DEI component to any of those initiatives. But what I would say is that I don't think this is going to be a legislative resolution at the end of the day anyway. I think there's a way to do this without it necessarily requiring legislative action, and that sort of eliminates some of the power that the Democrats would have unless they just took control of both houses, where it was a veto-proof majority, which is not something that I think anyone really contemplates that's going to happen politically. So I think that it's not going to become a legislative issue, although they could have hearings on it and do some other things, I suppose. But at the end of the day, the administration has a fair amount of latitude of what they could do in terms of the spinoff without needing a legislative solution with respect to it.
And finally, before I let you go, you have any thoughts on where the government will come down with this implicit versus explicit guarantee? Obviously, that's a huge sticking point, especially when it comes to what rates will do, then ultimately affordability for first-time home buyers, liquidity in the mortgage market, all those things. That's the big elephant in the room here.
It is, although I think that if you listen to both what President Trump has said, where he's tweeted that there would be an implicit guarantee, and what Mark Calabria said is that just by their nature, there's always an implicit guarantee just because of the sheer scale of Fannie and Freddie. And then you look at sort of where we are today, because today there's not an implicit or explicit guarantee, but they are in conservatorship. And we do know that the Treasury has been funding whatever needs Fannie and Freddie has had for the last 18 years. Even though on the MBS certificate, it's not guaranteed by the government, the practice is today that it's pretty much guaranteed by the government because the government's provided adequate liquidity for both Fannie and Freddie to continue to operate. And what you see is that there is an implicit guarantee, and there probably will continue to be one, just because it's kind of necessary in order for the liquidity to be there longer term and for the market to have confidence that that's going to be there. So I don't think it's going to be as big a sticking point as some other folks do. And I think you may see people talk about it more the way that President Trump and others has to reassure the markets. But at the end of the day, I think Mark Calabria is right that just as a practical matter, it's necessary, and everyone knows that. And if everyone knows that, it's there.
That could be the best answer I have ever heard in regard to that question. I always enjoy having you on the show. You know that. And thank you for bringing some clarity to this kind of unknowns. Always a pleasure, Marty. Thank you very much.
Appreciate it very much. Thanks for having me, Robbie.
Treasuries remained bid for the most part yesterday, digesting a solid but not spectacular $69 billion 2-year note sale. The government sold the short-term bonds at an interest rate or stop of 3.79%, which is a bit lower than what they've been selling for on average recently, of 4.08%. That's good for the government, as it means it can borrow a little more cheaply. There was decent demand as investors bid for 2.58 times the amount of bonds offered, just shy of the recent average of 2.62. A higher bid-to-cover ratio usually means stronger demand. Who bought the bonds? Regular investors or non-dealers bought about 87%, and within that group, direct bidders like big money managers bought about 26%, while indirects, which is often foreign buyers, took about 61%. Dealers, who often buy leftovers, ended up with about 13%, and before the auction, bond prices were rising and yields falling as demand was strong. After the auction, yields edged back up slightly, suggesting the market didn't see the results as especially exciting. On the data front, we learned yesterday that U.S. housing market data continued to soften this spring, with both the FHFA and Case-Shiller indexes showing larger than expected house price declines in April and early signs for further weakness in May. The FHFA purchase-only index fell 0.4% in April, while the Case-Shiller 20-city index dropped 0.3%, marking the slowest year-over-year gain since mid-2023. More current indicators, such as the Zillow House Value Index and median home prices, also point to declining momentum. We learned earlier this week that existing home sales remain sluggish at 4.03 million in May, with the listings-to-sales ratio hitting its highest level since 2016. Meanwhile, consumer confidence dipped in June as job market perceptions weakened, and although some Fed officials are beginning to advocate for rate cuts, Chair Powell maintains a cautious stance. We're still seeing projections anywhere from no change to interest rates in the second half of 2025 to up to 3 cuts. Bond buyers returned in the wake of a consumer confidence report for June that was weaker than expected and showed a drop in average 12-month inflation expectations from 6.4% to 6%. And underscoring anxiety about the expected impacts on the economy and job market from Trump's trade war. This month's retreat suggests consumers will remain guarded about their spending. Shifting to today, the highlight will be Chair Powell's return to the Hill to testify on the semi-annual monetary policy report to Congress before the Senate Committee on Banking, Housing, and Urban Affairs, though the day commenced with mortgage applications increasing 1.1% from 1 week earlier, according to data from the Mortgage Bankers Association's weekly mortgage application survey for the week ending June 20th. This week's results include an adjustment for the Juneteenth holiday. Later today brings new home sales for May. Expectations are for 690,000 versus 743,000 previously, and Treasury activity that will be headlined by $28 billion of reopened 2-year FRNs, $70 billion of 5-year notes, and a buyback in 7.5 to 30-year tips for up to $500 million. We begin Wednesday with agency MBS prices slightly improved from Tuesday's close, the 2-year yielding 3.79 and the 10-year yielding 4.29 after closing yesterday at 4.30%. Let's wrap up with a joke and some housekeeping. It's PG for language, so no complaints. You've been warned. A little girl was on summer break and some guy showed up to work on the house across the street. Being the curious type, she decided to walk over and offer her help. The guy said, sure, of course she could, so they gave her little jobs to do all week. Bring these screws over to Ray, and that sort of thing. After the week was over, they decided to give her a little payment and handed her an envelope with $50 in it. When she came home that day and showed Mommy her pay, Mommy suggested that they go to the bank and start a savings account. They went to the bank and the little girl proudly showed the money to the teller and told her she'd like to start an account. The teller was impressed and asked, "Where'd you get this money?" "I was working on a house," said the little girl. The teller replied, "Oh, and will you be working on the house next week too?" To which the little girl replied, "Yeah, if we ever get those fucking bricks from the goddamn quarry." Thought it was going to be she got the money from screwing Ray, but plot twist. Thanks again to Optimal Blue for sponsoring today's podcast. Optimal Blue bridges the primary and secondary mortgage markets to deliver the industry's only end-to-end capital markets platform, helping lenders maximize profitability and operate efficiently so they can help American borrowers achieve the dream of homeownership.